Hello everyone and welcome to TTT Markets. I am Fotis and today we are going to discuss one of the most powerful forces in global markets, the US Federal Reserve. More importantly, we are going to discuss how market expectations about the Fed drive price action before the Fed even makes a decision. Traders who know how to read expectations often get a significant edge over those who react only to the final rate announcement itself. Before we talk about trading, we need to clearly define what Fed expectations actually are. And I'm going to show you this tool. Before we talk about trading, we need to clearly define what Fed expectations actually are. And I'm going to show you this tool. Simply put, market expectations are the probabilities investors assign to future changes in interest rates, whether the Fed will raise, hold, or cut rates at an upcoming Federal Open Market Committee meeting. Markets don't just react to the actual decision, they react to whether the outcome was priced in or surprised the market. And as you can see here, this is the CME Fed Watch tool. There is a meeting on Wednesday. Today it's Monday when I am recording this video. And you will see here the probabilities for a rate cut. It's 2.8%. And there is 97.28 probability that there will be no change. And you can see this also right here. That means cut 2.8, no change 97%, hike 0%. So this is one of the most popular tools traders use. It looks at the Fed funds futures to calculate the probability of a rate move at the next FOMC meeting. When the odds shift, say from 30% to 70% for a rate cut, the market often moves before the meeting. So for the upcoming meeting on Wednesday, there is a 97% chance that there will be no cut. So the markets are already pricing this information inside price action. Another tool you can use is the dot plot, which you can see right here. If you click chart under dot plot, you get this. So what are these dots? The Fed's quarterly dot plot shows where each member of the Federal Open Market Committee sees the future path of rates. Traders interpret the median dot as the market's base case for future Fed policy. Now, if you see here, the blue dots are the median expectations regarding the future path of the interest rates. And you can see for most of 25, it was stable. For 26, it has moved lower. So there are expectations that within 2026, we are going to see a cut in interest rates. We will move lower into 2027, and then some stabilization around these levels. So you see, the expectations regarding the future path of interest rates is lower. Investors, traders are expecting that interest rates will move lower. They are expecting the Fed to cut. So this is telling you something also about what they think about the strength of the economy, and also consider what does this mean for the US dollar. There is another tool I wish to show you, and this is the Fed Speak Forward Guidance. And I'm going to show you this here straight from the Board of Governors of the Federal Reserve System page. So when Fed officials speak in public, in speeches, testimonies, or during a press interview, market is analyzing every word for direction. This is known as forward guidance, and it is a powerful driver of expectations changes. Now, you need to understand why expectations matter more than actual moves. And please pay attention, this is a key point. And let me go back to the Fed watch tool, and I will use here the probabilities. What moves market is how the Fed's decision changes traders' view of the future path of policy. I think better to move to the dot plot. So based on the information we have up until the 10th of December 2025, these are the median expectations. Please remember, it is the blue dots for the future path of interest rates. But in the future, if the Fed holds but signals more cuts ahead, that can be bullish on risk assets. If the Fed cuts but warns, they are letting us know that inflation is stickier than expected, the markets could sell off. So what matters is not the actual price right now. What matters is what is the future path, what are the expectations. And the expectations can change as new data are hitting the market. For example, we are expecting the Fed to cut rates. Okay, but let me ask you this. What will happen to future expectations if suddenly we have high inflation? So can you see why expectations are even more important than the actual numbers? Now, how to trade those expectations? Number one, position before the move, and I'm going to use here the Euro-USD chart. If you believe the markets underestimate the probability of a rate move, you can enter ahead of the shift. For example, you can go long Euro-USD if you think a US rate cut is more likely than priced. So you can see here from last week, Euro moved up. This is because of expectations that we are going to see lower interest rates. As you can see right here, we are expecting a new head of the Fed that is going to be more accommodative, more dovish. That means they will have lower interest rate policy, and this is reflected in this move up. So if you think that that is the case, you can go long Euro-USD before even the Fed meeting. Number two, trade the probability shift. When the odds of a rate move shift sharply, that often shows up first in FX, yield curves, and interest rate futures. Right now, if I go back here to current probabilities, it's 97% no cut, no change, no change. Nothing is going to change, and there is a 97% probability. But if you see a sudden shift, then this is something you need to change action, you need to pay attention and position accordingly. How can you tell if this is something you can rely on? Well, pay attention to the yield curve and the fixed income markets, the bonds. And usually this will also translate in FX. You will see this straight away in the currency. If expectations flip quickly, as they often do around major data releases, you can have a volatility spike. So when you plan your entry and exit, you must always have a clear risk limit. So yes, you anticipate something, but at the same time, always consider that you might be wrong and use a stop loss appropriately. When you trade around FOMC events, the rate decision, press conference, dot plot releases, they all create short-term liquidity and volatility. So know the clock. That means know when we are going to have a Fed event, because this is going to affect expectations, and if expectations change, this will impact the currency. You can also use cross-market signals. You can look at bond yields, you can go here, you can type US if you wish to look at short-term yields. There you go. So you see the short-term yields right now, you see they are moving lower. Again, we are expecting no change, but we are expecting in the longer term the rates to move down short-term yields are moving lower, and you can see Euro USD is moving up. So you can use cross-market signals, especially yields, to understand a little bit better the expectations and have a confirmation if your view is accurate or not. Now, what happens if you have key data releases? So if you go to the calendar and you see we have key data releases like inflation, the CPI, PCE, employment, and GDP. Remember, inflation, employment, and growth, the GDP. Those influence what the Fed may or may do next. You will see if there is something significant, you will see a big change in the Fed dot plot. So strong inflation, for example, and jobs data generally reduce the odds of cuts. Weak data increases them. So if market is pricing an 80% chance of a Fed cut and it suddenly flips to 30% after hotter than expected inflation, then the probability shift, not the final Fed move, can drive price action. So you need to pay attention to that. Let me give you a practical example. Let's say a week before the release, if I go back to Euro USD, so I'll go Euro USD, there you go. Let's say we have expectations regarding the dot plot, and there is a 40% chance of a rate cut. But then over the next few days, we have new labor data coming in, new inflation data, and suddenly from 40% it moves to 75% for a rate cut. So what do? You should expect the USD to weaken and bond yields might fall. Risk assets like equities might rally before the Fed even meets. So what have we done today? In order to read and trade Fed expectations, you need to understand the tools, the Fed watch and the dot plot. You need to monitor key data releases. You need to pay attention to Fed speak and forward guidance. And lastly, you need to trade the change in expectations, because this is where the real edge is. Thank you for watching. I'm Fotis here at TTT Markets, and I will see you in another video.